Hey everyone, this is Nikhil Daman at Campus. Happy Friday. Today we're going to be discussing the current mortgage rates and interest trends, along with the CPI index and inflation, and how it has been affecting housing or how it will be affecting housing over the next few weeks, months, and maybe 2023. Let's start by having a look at this chart for mortgage interest rates. And here I've put together some long-term trends since 1976. So as of now, the rates are at about 6.5%. They've dropped by about 0.5% from the previous week. But if you go back to 1976, the rates were pretty high at like 8.5%. They then went up all the way to 18.5% in the early 80s, kept dropping to about 10% in the 90s, and a little lower than that. And they kept going up and down until we reached the housing crisis in 2006 and 2008, rather. And at that stage, they were at about 6%. At that time, the Feds reduced the pricing, or rather the interest rates, and it went down to about 2.5% to 3%. And we kept going down and up and up and down until we reached 2021 at the lowest level. And now we are back up again in 2022 at just about 6.5%. So these are the trends that are going on over a period of time. Now, what does that mean for the housing market? It's pretty simple. You need to marry the house you like and date the rate. Now, this is not Tinder by any means, because this is not a one quick fix shop. You have to be patient enough in order to win. So what you need to do is, if you like a house and if you're a first-time home buyer and wanting to move into that particular house of your choice, you should make that move. Take the interest rate, whatever is available to you, and then once the rates drop, you can certainly refinance and get what you need. Okay, so let's move on to the CPI index for now. Next, let's look at the CPI chart for inflation since the beginning of 2021. Inflation in Jan of 2021 was only at 1.4%, and then it started creeping up till it reached 7.5% in Jan of 2022. It peaked at 9% in June of 2022, and we are now back down to 7.76% in October. The good news is that inflation has seen a slight drop and has moved down to the levels of Jan 22 as of today. So the interest rates have been driven artificially and intentionally by the Feds to tame inflation and to reduce the free money available to the consumers over the last couple of years. Now, how does that affect the housing market? Well, the rise in interest rates has most certainly affected real estate, with a drop of about 15 to 20% in most of the Bay Area. You need to look at the drop in asking price and sale price. Some buyers are simply out of the market, as their debt to income ratios do not match up with what the banks require it to be. So some banks require 36%, some require 43%, and so on. But the ones at 43% also are finding it hard to lend. Add to that the woes of low inventory. So we are going back to the economic concept of demand and supply, which in the Bay Area has always been the case and will remain the case. So this is a great time to avoid major biddings and getting into the home of your choice. Reach out to me today and let me help you get over the line. Thanks for watching.